Welcome back to Derivatives and Risk Education. This video is the first of a short series on interest rate swaps, or IRS. We'll start with a general introduction of these products. Then we'll look at how the payments in a standard fixed floating IRS are calculated. I'll then cover the important practical issue of day count conventions. And then we'll see how a standard IRS can be used to transform both assets and liabilities. In the next video, we'll look at valuation. As we saw in a previous video, a swap is an agreement between two parties to exchange cash flows in the future. The agreement defines how the cash flows amounts are to be calculated and when the cash flows are to be paid. Usually, the calculation of the cash flows of the swap involves the future value of some market variable, such as an interest rate, an exchange rate, share price, or commodity price. In the interest rate case, the most popular type of swap is one where a fixed rate is exchanged for a floating rate. As it is so common, when people say a plain vanilla swap, they'll mean a fixed floating interest rate swap, with the floating rate and the payments all in the same currency. The main other types of interest rate swap are cross-currency swaps, which have payments in two different currencies, and so-called basis swaps, which involve exchanging cash flows based on two different floating rates. Today, we'll just look at the basic fixed floating IRS. So let's look at an example. Party A has agreed to pay a fixed rate of 5% per annum to Party B. In return, Party B has agreed to pay a floating rate referencing 6 months SOFR. The notional principal amount of the swap is $100 million, and it has been agreed that payments are exchanged every 6 months until the maturity of the swap after 3 years. Let's look at the payments in this swap. The first payment will be made after 6 months. Party A always pays fixed 5%, so its payment is 5% times the notional amount of 100 million. But 5% is an annual interest rate. So to work out the payment, we also need to multiply by 0.5, as 6 months is half a year. So every 6 months, Party A pays 5% times 100 million times 0.5, which is $2.5 million. Now we said that Party B pays 6 months SOFR. This is a floating rate with fixings every day. In a plain vanilla IRS, the floating rate is observed at the start of each period and paid at the end. So for Party B's first payment after 6 months, we need the 6 month SOFR rate at the start of the swap. Let's say this rate is 4.2%. Then Party B's payment after 6 months is 4.2% times 100 million times also 0.5, so $2.1 million. So Party A has agreed to pay $2.5 million and Party B $2.1 million. In practice, only the net cash flow is paid. So the only cash flow is that Party A pays $0.4 million to Party B. Now, in the cash flow calculations, in our example, for simplicity, we used 0.5 because each payment related to a period of 6 months or half a year. In practice, this number typically won't be exactly 0.5, as it depends on the so-called day count convention specified in the swap agreement. For a floating rate in most currencies, the convention is to use the actual 360 convention, which means that we would take the actual number of days in the relevant period and divide this by 360. For fixed rates, a common day count convention is 3360, where each month is counted as 30 days. All the conventions are of this form, A over B, with the first part, like actual or 30, referring to how to count the days in the period, and then the second part, like 360, specifying how we count the number of days for the whole year. Some other examples of day count conventions are actual and actual 365. Now let's look at two use cases of fixed floating interest rate swaps. These illustrate how a swap can be used to transform both assets and liabilities without touching the underlying investment or loan. We'll first look at an example of a swap that transforms a liability. Let's say a company has issued a 10-year bond paying a fixed rate of interest of 5%. It has issued the fixed rate bond because its investors prefer a constant rate of interest, but the company actually prefers to pay a floating rate. So the company has entered an IRS, where it receives 5% and pays 6 months SOFR plus 50 basis points. Let's see what the net position is for this company. It pays 5% on its bond, but now also receives 5% fixed in the swap, so the fixed rates offset. So the net cash flow of bond plus swap is that the company pays a floating rate of 6 months SOFR plus 50 basis points. So the company has indeed used the IRS to transform the fixed rate liability into a floating rate liability. Note that entering the swap comes with credit risk to the swap counterparty, so it does introduce some extra risk. I should point out that this is a very realistic example. Banks will often pitch new bond issue ideas to companies, and they will propose a package of a bond plus a swap if, like in our example, the investors prefer to receive fixed, but the company prefers to pay floating, or the other way around. Now let's look at transforming an asset. This will work in a very similar way. Let's say an investor has an asset paying 6% but wants to receive a floating rate. The investor can enter a swap where it pays 6% and receives, say, SOFR plus 150 basis points. So the asset paying 6% has been transformed into an asset paying a floating rate of SOFR plus spread. This is also a very realistic and common example. To make assets of different coupon rates, credit quality, and maturities more comparable, interest rate swaps are often used to convert assets paying fixed or even structured coupons into floating rates. An IRS used for this purpose is called an asset swap. That brings us to the end of this video on fixed floating interest rate swaps. We looked at how payments are calculated, discussed day count conventions, and saw how IRS can be used to transform both assets and liabilities. In the next video, we'll look at how interest rate swaps can be valued. So don't forget to like and subscribe, and I'll see you in the next video.